Welcome back to Galaxy Tenants. My name is Carly, and co-producing this episode is my husband, Jay. On episode 9, we have a conversation with Kris Spuckes about the mortgage industry, and we feature Whatcha Gonna Bring off of the Motet's 2019 album, Death and Devotion.
I'm here with my friend Kris Spuckes, who I just found out his nickname is K Spew. After a decade of knowing you, I just found out that that's your possible nickname. I don't know, that's one of your username that I'm calling you on. But Kris stood up at my wedding. Kris is in some of the previous Burning Man stories we featured on the podcast. Welcome to the podcast. Can you tell folks about what you do?
Sure. Thanks for having me. I've been working for the last 18 years in the residential mortgage lending business. Right now, I'm a vice president of operations for a local independent mortgage banker.
I'm sure your industry has been maybe, thrust into chaos is an exaggeration, or maybe you can paint a better picture, but how have things changed with the coming of COVID-19?
Yeah, well, I think you said it very well. It's definitely been thrust into chaos. Things are changing very quickly. You know, obviously, when we talk about lending, in particular mortgage lending, a lot of it's risk-based, and it's based on people's stability of income and ability to repay the mortgage. So when you have 26 million jobless claims in 5 weeks, that takes away a lot of people who could qualify for loans are no longer able to. So that's, one aspect of it. The other aspect is, from an industry perspective, as the government encourages mortgage servicers to quickly approve forbearance requests from consumers, obviously that impacts the revenue stream that the servicers depend on to generate income. So you've got it. It's at the same time, it's becoming more difficult for consumers to obtain loans as well, because the banks and entities that issue these loans are taking this risk into consideration with all the new jobless claims and the potential of people going into forbearance. So, guidelines have tightened up as well. So it's harder to get a loan, less people are qualifying, and the industry's, potentially facing some significant losses with the current situation with borrowers requesting forbearances on their loans. People that have not been disrupted by COVID, like you still have your job, you haven't lost any income, you should keep making your mortgage payment. You should not call your servicer and say, I want to take advantage of this forbearance option and not make payments for 3 months. Number one, because in order to do so, you're attesting that you have been impacted by COVID. Like the government told the mortgage companies, approve these quickly. Don't ask for any paperwork. Do it right away. We want to help these people. But in order to do so, you're saying either I've lost my job, my income's been reduced, or I've been physically sickened by this disease and I need some time off from my mortgage payment. So a couple things is if people just decide, screw that, I'm going to go ahead and apply for forbearance, even though none of this has ever happened to me, potentially when this all winds down and the servicer asks for proof that you were impacted and you can't provide it, you could get, I'm going out on a limb here, but technically you're lying to your mortgage company, which is not a good thing to do, right? So you could probably get some sort of repercussion for that. And then the other aspect is if you go into forbearance and then, later on down the road, you want to buy a house or you want to refinance your loan, if that reference shows up on your credit, the lenders are going to know that your income was affected, you applied for forbearance. And as of right now, we don't really know how that's going to impact what we do in the future and whether we're going to look at that negatively when we decide to make a loan or not make a loan. So I guess my only message there is just because the government says that, servicers should approve these forbearances, if your income's not impacted and you still have the ability to make your mortgage payment, you should continue to do so. The program's there for people that truly were impacted to help them get through the time that they've had a reduction in income. It's not for people to just take advantage of free mortgage payments.
With those programs, is it typically that they give people like a few months not to pay, and then on the first month where they have to pay, it's all due, or do they tack it on to the end of the
So
loan
we're
period?
kind of learning more about that too as it goes, again, because it's sort of new, but so it's definitely got to be paid, right? It's not going to be free. You're hitting pause. To your point, do they have to make all 3 payments when they come out of forbearance? Well, I think that's probably what the servicers would prefer. But if you just had to take 3 months off from making your $2,000 mortgage payment and you just went back to work, you probably aren't going to have $6,000 to pay a lump sum, right? So the assumption is that at that point in time, there would be some other sort of loss mitigation that was done between you and the servicer, and they would either put it to the back of the loan, or they would, set you up on a payment plan to repay those 3, 6, 12 payments you missed through your forbearance program. But there would be options given to you, right? But again, how those options are going to impact your future ability to get loans, that's kind of not yet known, right? So if I modify my loan and I tack on my balance those 3 months onto the end of the loan, that might show up on my credit forever as a modified loan, right? And then how are the lenders going to treat that, knowing that you had to go to those measures to get, through the last situation? It may be nothing, or there may be a waiting period. Like you can't get a loan for 6 months after you had a modification or forbearance. So we got to see how the guidelines come out in relation to that. But, in the end, they're not going to give you 3 months off, J-Man, and then foreclose on you. They'll work with you to give you options would be the answer. But it's due, whether it's due as a lump sum or if you make arrangements to pay it at the back of the loan or payment plan, would be up to the servicer and situation is probably the answer.
Okay. So yeah, it's still, no matter what, you're going to end up paying it. Obviously, it's just a little bit of time to get back on your feet so you can make those payments. But
right.
Yeah, I was
hitting
concerned.
The pause button.
Yeah, hitting the pause button. Right. I was just concerned that people would have to pay it all in one lump sum as soon as that 4th month hit, or whenever they're coming out of the forbearance. So
yeah, and like I said, I think that's probably going to be the initial thing. Okay, your forbearance is over. You owe us $6,000. And then it's going to be up to the customer to call their servicer and say, I don't have $6,000. What options do you have for me? And then from there, they'll figure out something to do for them.
Are you still working at Current, or are you working from home or remotely, or how's that working?
Yeah, definitely. I've been working from home since March 21st, basically the day that Denver put the stay-at-home order in place. It doesn't really make a difference for someone like me. I'm on email and phone all day long, so I don't need to physically be in the office. We do still have some people in the office, minimal staff right now. One of the things is when you get documents coming back, somebody's got to scan those in for the closing. So there does have to be some physical people there to do certain functions, but the staffing's been at a minimum at the office, since the stay-at-home order went into place. We are talking about bringing some people back in the next couple of weeks with the lightening up. So that's kind of where we stand from a perspective of where we're physically working. You've mentioned, am I still working? It's kind of an interesting time because at the same time as we're dealing with all these changes and turbulence in the industry, we're super busy. Interest rates are at historically low levels. So refinance applications prior to COVID-19 were off the charts, and we're still working to get those loans through our pipeline. So, we're the same time as we're faced with some serious challenges, we're also setting volume records for loans closing in the last couple months. So it's a very interesting situation. With that said, there's a lot of, it's a good time for business right now, but we're also very weary of where it's going to be in a couple months with the jobless situation and depending on how quickly the economy can recover from this and how soon we can get past the threat of the virus, I guess.
Right. Are there programs for people who have been impacted by COVID to possibly help them obtain a loan, or how's that looking?
Yeah, I mean, that's probably not really, the answer to that short and simple is no. I mean, if, the more of the programs that are out there are to help people who currently have a mortgage that are having trouble making their payments due to the impact of COVID. But, unfortunately for people who may have lost their job due to the shutdown and due to COVID, they don't have the income to repay the loan, and the banks and lenders out there aren't going to write loans to people until they have the income stability to do it. So, I would say that I think that probably the last thing these people are thinking of right now in terms of, without being employed would be getting a new loan. Obviously, a lot of them would want to refinance maybe to save money, but that's not an option if you're not working. So, the better option for those people who might be financially impacted and having trouble making their payment would be to contact their servicer and try and obtain a forbearance where they don't have to make their payments for a few months. Once everybody's back to work and their income is stabilized, certainly we hope to be able to write loans for them. It depends on what the long-term financial impact is of COVID on each individual situation. If they're self-employed is a good example where their business has, been shut down and they're not able to, or if we have a slow return to normality, that business, although it may be somewhat operational, is not operating at the same level of income as it was in prior years. And, that's something that lenders have to take into consideration when they're looking at the risk on a loan is that business going to be able to generate the same type of income it's generated historically? Because that's what we're using to determine if they qualify for the loan. So it'll be an interesting situation as things start to return to normal. For right now, if your business is closed or if you've lost your job due to COVID, you're really not able to obtain a mortgage loan at this time.
How does this compare to 2008?
Yeah, so it's interesting. And I think one of the things I would say is that as we got out of 2008 and the economy started to recover, 2008, I was working in Las Vegas. And I mean, it felt like the end of the mortgage world. Property values declined sharply, which resulted in kind of a cascade of people just foreclosing on their homes and letting them go, which then, of course, resulted in the collapse of the world economy, not just the mortgage industry. This is more, it's an interesting situation because we'll have to see how it's very deep in terms of it being the deepest depression or recession we've had since the 1930s. But, where 2008 was an extended trench that carried out for several years before the economy started to recover, we'll have to see how this works. If we get past the virus, will the economy rebound immediately? And if that's the case, then you might start to see a loosening back up. So, as we got out of 2008, you gradually started to see from 2012 until the present where guidelines loosened up a little bit. Some of the programs that we used to do back before 2008 started to come back. Programs with alternative income documentation or higher loan to values, meaning you could borrow with less money down. Those programs started to come back as we moved further into time away from 2008 and banks started to gain more confidence and property values stabilized and, went way up again. So banks started bringing back some of those programs. And then as soon as COVID hit, boom, we shut all that down. The non-prime lending just stopped. Investors are putting in higher credit score requirements now, reduced loan to values. So again, now we've got another major economic event and you see the lending tightening up. And I think that's something we learned from 2008 and lenders are reacting to that. They don't want to have any bad loans written, in times where people can't make the payments. So it's similar, but in some ways it's a little different because we've learned a little bit from the past and we're not, the loans that have been written over the last several years are better quality loans than what we were writing before 2008. So I don't know that you're going to see as high of a default ratio from this. But again, if people are out of work for prolonged periods of time, if there's a second wave of the virus and we go back to a shutdown, I mean, nobody knows right now, Jay. It's early on in the process and things are changing daily and, we're just going to have to see how it plays out.
I was going to ask you that. Are the policies at your company changing like extremely frequently where you're constantly getting emails about new policies to implement and how are you handling that?
Yeah, I mean, it's, in my organization, it's a little bit smaller. So I'm on the calls when we talk about it and it's daily, if not hourly, things are changing. We're watching other lenders in the industry. And of course, the main thing within our industry is the guidance that comes down from Fannie Mae and Freddie Mac and the government agencies like HUD and VA. So, as they make announcements, lenders react to the announcements that the agencies make. And, they're constantly changing. And it's been very hard for all of our people on our team to keep up with all the changes because there's so many of them. But, it's all in the interest of making sure that we're managing risk properly and, in the end, being able to produce good quality loans that are going to perform and, help borrowers who are going to make their payments and not put borrowers into loans that aren't going to be able to. Right.
Is Ben Carson the head of HUD?
He's the head of HUD. Yeah.
Fuck.
There was something that happened. I mean, it's quite a while back, but commonly referred to. You probably saw the comments. I don't need to say this again, but I mean, he's clearly removed. I mean, he's a medical doctor. I don't know what he has to do with housing and why he was appointed to that position. But I still think one of the funniest things, and this is a few years back now, shortly after he was appointed, but somebody, a congresswoman or something, was speaking with him about REO, which stands for real estate owned, which usually refers to like properties that are owned by HUD because somebody didn't make their payments on the loan, so it was defaulted. And he didn't understand the question and thought she was asking him about Oreos. So, I mean, again, where my politics stand, and but one thing I would say is that, for what we do, is Ben Carson is over HUD, which would kind of govern one of the loan types that we do, which are FHA loans. But, the FHFA is really the governing agency of Fannie and Freddie while they're in conservancy. So, Ben Carson has some impact, but I don't think he sets the majority of the policies that impact our industry, I guess would be my point.
That's fair. What's the most challenging part of your job, and what do you enjoy most about the work you do?
Oh, I mean, I don't know. I think it's kind of, I think everyone who works in a specific industry is kind of passionate about what they do. I think, mortgages are interesting. I mean, in the end, you're helping borrowers to home ownership, which is the, nice vision of what we do, but it's also, as Wall Street as it gets, these loans in the end just basically become assets that are securitized and sold on Wall Street as a bond. So, I mean, you're helping people into home ownership, but you're also mitigating risk and making sure that the product that you have is sellable in the secondary market and going to perform. So it's an interesting. There's a lot of analytics that go into credit risk involved in whether or not someone qualifies for a loan. And there's one of the things I do is I help our sales team with different scenarios daily and how we can structure this deal to make it work. Or is this going to work? Is this certain thing going to be able to let the borrower qualify? Or is it going to prevent them from qualifying? Is there a way we can get around it? Those types of things. And that's what I really enjoy about it. What's challenging is in my position, I need to balance the risk of the company and what, company policies are so that we can ensure success going forward with trying to keep our salespeople happy who obviously want to do every possible loan they can for every possible person. And because they make commissions and at the same time, they want to help the realtors and the borrowers that are involved as well. But, there's a balance there, and getting in the middle of that is a bit challenging sometimes. As we make changes, particularly in relation to COVID, and we start to become more restrictive, that impacts the number of loans that our salespeople can do. And there's a lot of kind of different opinions of what we should and shouldn't do. So you kind of got to keep them happy while, supporting the company and the decisions that we make to make sure that we are successful going forward.
I noticed your shirt says SCI. What does that stand for? What's that?
This is shirt. Actually, I got that 2010 Red Rocks for Spring Cheese incident where I met you, buddy.
Oh yeah, that's great. It says roots run deep. Indeed they do, my friend. Indeed they do. What have you been doing at home to keep busy during this time besides working from home? Doing a lot of
Yeah, it's
drinking or farming, or I saw you get some, what is it, some chickens or something? How's it being a farmer now?
well, Teresa does the chickens. I don't really take care of them, so she handles all that stuff. I've been keeping busy by reading. I've been working out every day.
Yeah,
I
you
guess
look
I do a
ripped.
little drinking. I've been
Cool.
trying not to abuse that during this time.
Yeah. When the chickens they lay eggs, I assume, and do you guys eat those for breakfast and whatnot?
Yeah, the chickens lay a lot of eggs. We got 3 chickens, so they lay probably 2 eggs a day on average between the 3 of them. So
Wow.
it starts to pile up, man. We can't eat the eggs fast enough. Got a carton for you if you want
100%.
them.
Do you name the chickens?
Yes, the chickens have names.
Would you like to share the names with us?
It's Thelma and Louise. Those were the first 2.
Uh-huh.
And then the latest one is Henny Penny.
I like that. I like that. I'm inclined to ask you to like tell a story or something because you have some of the best stories, but at the same time, I don't know that you want to tell some of the stories that you have told me in the past.
What story would you like me to share with you?
Like my favorite story that you tell is the one at the ski resort where you got hammered and you were telling that chick how awesome you were at skiing and then you hit the moguls. And then you called me from Railroad Earth that night.
I can tell that one. It's probably better when I'm drunk, but I can tell it now if you want.
So let's give it a whirl. I mean, you don't have to be drunk to tell the story because it's a beautiful story from start to finish. I don't think your level of intoxication affects how incredible the story itself was. So tell me, what ski resort were you at?
Copper Mountain.
Copper Mountain. And so what was the deal? You were skiing and did it start dumping? So you went to the bar on the mountain or something, or?
No, kind of the opposite. It was like early April, and we went skiing, and we started out at like 9:00 and took a couple runs, and it was super icy and not very fun. So we stopped at the bar at the base of the accelerator lift at Copper and had a couple tall boys there. And that was probably 9:45-ish. Well, and so after those 2 tall boys, we skied down to the base, which is like the Jack and Jill bars, I think they're called. I think we were at Jack's, and there's an outdoor patio, and it was sunny, and we were just doing Jaeger shots after Jaeger shots after Jaeger shots. And yeah, there was a couple girls that came up there. This is years and years ago, and we were just drinking, talking to these girls, and they said they wanted to go for go up and go skiing. And I was like, yeah, let's go get another run in. So I went up with them on the lift, and we got to the top, and by this point in time, I should say that I probably had 8 Jaeger shots and 6 beers. And it was maybe 2:30, 3:00 in the afternoon, and got to the top of the lift, and it was like a blue run, but off to the right there were some like a little field of moguls. So I just dropped right in there, thinking like I was not 14 deep, and took 2 turns and hit a bump and just exploded with skis and poles and helmet and everything flying all over the place. And those girls kept going, and I never saw them again.
It's probably for the better. I think, was that the same day that you got down and you went down the wrong run, so you missed the shuttle?
The car was parked in a remote lot, so we never went back. We skied and ended up basically in the same place we were all day, and it was getting to be late evening, and we needed to take a shuttle back. But as we were sitting there contemplating taking the shuttle back, I started seeing all these people kind of walking in street clothes into this one building. And so I, inquired to somebody, what's going on in there? Where are you guys going? And apparently it was Railroad Earth was having a concert at Copper Mountain that night. And people were starting to go there to get ready for the concert. So I proceeded to wander into the venue with my ski boots on and attempt to purchase a ticket to go in and watch the show. But I was advised by security that I could not wear my ski boots into the Railroad Earth show.
That doesn't
So,
seem unreasonable. However, I got a text from you asking me to text one of the members of the band to come up front and let you in. And I think I just texted you back, no.
That's a good choice. Good choice on your part.
Yeah, I hope their evening went well from there. Well, I appreciate you taking the time to do this, bud. I can't wait till this whole thing's over and we can go to a concert together again.
Yeah, looking forward to it, man.
We leave you with Whatcha Gonna Bring by the Motet.
What you gonna bring today? Ain't got the time to waste. You better believe. What you gonna bring your way? If you don't take the time to say that they got to believe. I don't pretend to be a better man than the man that passes by. No matter if it's skin or his religion, that ain't the same as mine. I'm more concerned with the question, how do you live your life? Is it through judgment and hatred, or love for all mankind? So what you gonna bring today? Ain't got the time to waste. You better believe. What you gonna bring your way? If you don't take the time to say that they got to believe, we all got to be free. You know there's beauty in a smile from a stranger, a hug from a friend, a kiss from your lover, or just some good conversation.